Hello guys and welcome back to another video. Now I've got a slightly different video today, transiently moving away from the deep dive analysis stock videos that I usually do to talk about inflation and its impact on the stock market. So I'm sure we've all seen or heard on the news how inflation rates for April have increased to 4.2% on the prior year, and I'm absolutely certain we've all seen the impact that that's had on the stock market. But a lot of people that are new to investing might not know why high inflation is causing a stock market sell-off. And so that's what I'm going to explain today in a very simple way. But just before we get into the video, guys, I just want to say a massive thank you to everybody that has subscribed to my channel so far. I started this channel just under a month ago and we're already almost at 100 subscribers, which I think is amazing. I haven't pushed this channel to anybody that I know personally, and so the channel has grown completely organically in that time, and I just think that is fantastic. So thank you for that. If you do enjoy the video today and you haven't subscribed already, then please help me get to that 100 subscriber milestone. It will be truly appreciated. But now with the shameless solicitation to subscribe out of the way, let's get into the video. So first of all, what is inflation? Inflation is defined as the decline in purchasing power of a given currency over time. In other words, £100 or $100 today will buy you more than £100 or $100 a year's time from now. And the most commonly used inflation index is the Consumer Price Index, which effectively takes an imaginary basket of goods such as food, fuel and clothes and compares the price of those today as to what they were a year ago. Now, a level of inflation is actually a good thing, as it encourages people to spend their money today rather than wait, for example, a year from now where that item will be more expensive. And therefore, more people spend their money and this stimulates the economy, creates jobs and so on. But it's the rate of inflation which is really important. Now, generally speaking, governments will try and keep inflation rates at around 2% per year. And over the last 25 years or so, they've pretty much managed to achieve that, meaning that the economy has been functioning by and large as intended. Now, ultimately, the rate of inflation is driven by the level of money supply within an economy. And as the level of money supply increases, inflation increases, meaning the purchasing power of that currency decreases. Now, I'm sure we all saw the headlines back in October, which said that nearly a fifth of all US dollars was created in 2020 as a result of the Fed printing money in response to the pandemic. And that led to widespread fear of inflation, which many people think we're now starting to see play out. Now, if the supply of money increases too rapidly and becomes out of control, then inflation can become out of control as well. Everybody remembers one of the most extreme examples of this, where in Weimar, Germany, they experienced hyperinflation, where a loaf of bread went from costing 1 mark to costing 200 billion marks just 5 years later following World War I. In fact, cash became so worthless that it became cheaper to burn the cash to keep warm rather than use it to buy wood and coal. Okay, so you're thinking, why does inflation matter to stocks? Well, the first thing to understand is that inflation rates and interest rates have an inverse relationship. And the Fed will attempt to influence the rate of inflation by increasing or decreasing interest rates. Now, seeing as they have an inverse relationship, if inflation rates get too high, then the Fed will try and increase interest rates to try and push down the inflation rates back to the level which they think is acceptable. Therefore, the concern is that if inflation rates get too high, then the Fed will have to increase interest rates to try and bring it back down again, and this can have a significant impact in many different ways. So one of the impacts of higher interest rates is higher borrowing costs, and that's both for businesses and individuals. So those people with mortgages, for example, will have to spend more on interest, meaning that they have less money to spend, which means that less money will be going into the pocket of businesses. And also businesses won't be able to grow their businesses quickly or as cheaply due to higher borrowing costs. Another impact of higher interest rates is that people now see a better return on the cash that they hold, meaning that people are encouraged to save more money and therefore spend less money, meaning that some businesses are going to be impacted by that due to reduced sales and reduced profits. And then finally, another impact of higher interest rates is a higher weighted average cost of capital for businesses, meaning that when we're discounting their future cash flows, we're going to use a higher discount rate, which means that we expect a lower rate of return in the future. And this would have the biggest impact on high growth companies, which aren't earning much today, but are expected to earn a significant amount of money in the future. And that's why we've seen a lot of stocks which are really popular with YouTubers, which are the high growth speculative investments, fall by a significant amount in the last couple of months. Now, I fully appreciate how that's just a bunch of words, and it doesn't particularly help you understand how an increased interest rate can lead to a decreased intrinsic value, particularly when looking at growth stocks. So I thought I'd run you through an example. I'm using my Amazon example from the Amazon video that I did previously. But here we can see that I have calculated a weighted average cost of capital of 7.6%. And when we go across to the intrinsic value as a result of that, we get an intrinsic value of $4,600 for Amazon. And if you want to see the video on this entire deep dive analysis, then please feel free to do so. It's on my YouTube channel. But just going back, if we were to increase the weighted average cost of capital, and again, that would be increasing because The cost of debt would be increasing, but also the return expected from any investors would also be increasing. But if we were to increase the weighted average cost of capital to, let's say, 11%, and now if we go to look at the intrinsic value of the company, we can see that the average estimated intrinsic value for Amazon is now $2,900. So that is a significant decline from the $4,600, which I calculated previously using a weighted average cost of capital of 7%. So if we want to see the detail as to why we see that decrease in intrinsic value with an increase in weighted average cost of capital, it's all down to the present value of future cash flows. So we can see here that we've got the free cash flow, and then we've got the present value of future cash flows. And we get that by multiplying by the discount rate. So with a greater weighted average cost of capital, you actually get a smaller discount rate, which means that when you're projecting further out into the future, the present value of those future cash flows are a lot lower. So what should we all do? If you think that higher inflation is here to stay, then you don't particularly want to hold on to cash, as your purchasing power is going to be eroded. By the same token, though, you also don't want to be holding on to high growth and speculative investments, as the returns on those are going to be lower. So what is the answer? Well, first of all, I don't think it's all that surprising that inflation rose by 4.2% in April this year compared with April last year. If you remember where we were a year ago, everything was closed and therefore nobody was spending their money. So it's not that surprising that a year on, when everything is opened up, that prices are going to have increased a little bit. With that being said, I think we probably will continue to see higher inflation rates in the short to mid-term, but that's not going to change my investing strategy. I'm going to continue to invest in solid companies that are growing their revenues, growing their earnings, and growing their free cash flow. And if I see a dip in the prices of these companies with absolutely no change in their fundamentals, I'm going to continue to buy more. All of the stocks that I invest in are companies that I believe in and companies that I'd be happy to hold for the next 5, 10, 15 years. So why would I care about short-term price fluctuations? Anyway, guys, that's just my opinion and the actions that I'm currently taking, but hopefully you can take away today why inflation rates have an impact on the stock market. Hope you found the video useful, guys, and if you have, please press the like button. Until next time, guys, thank you.